Hey, good morning. So if you know me at all, you know that I usually do Wordle in the morning, but today I have to deal with the RRP decline and what is going on so people can stop making awful takes on the RRP. So let's start by sharing my screen. Here is the RP, the Overnight Reverse Repurchase Agreement program that the Fed has that offers money market funds a place to keep their money. And we've noticed as bills issuance has increased that a lot of the people, the portfolio managers at these money market funds that are invested in the overnight reverse repo have decided to redeem their investment and buy bills. And so that has an implication on the Fed's balance sheet, meaning one of their liabilities has disappeared. Now, if you know anything about accounting, if a liability disappears, either a new liability has to occur or an asset has to fall. And so I'm going to go through the principal, by far the dominant things on the Fed's balance sheet to say what's happening. So you can see there's been a significant drop in the RRP. So what has changed? Well, as I said, if the liability, the RP, falls, one of the sources of that fall can be a fall in the assets of the balance sheet. And so the principal asset the Fed has is its SOMA portfolio, which is its mortgages and bonds that it owns. And you can see that just as the RRP has fallen, the SOMA portfolio has fallen. And this is called QT. And to be clear, the reason why this is falling is partly because the Fed is doing QT. It is reducing its assets. So the driver of the RRP fall is not the bills issuance. It's the fact that the assets are falling. So a liability must fall. Okay? So that's come down. Now, this is very steady. There's a little wiggles in it. It's really exactly 60 billion of treasuries a month and a variable amount of mortgages as the mortgages are coming off very slowly. This is obviously bounced around a little bit, and that's because there's some liabilities that are moving around a little bit more volatilely. So let's talk about that. Now, to be clear, the assets haven't fallen as much as the overnight repo has, as the RRP has. So something else must be happening. And it is. Firstly, and by far the most important thing that is causing the RP, even more so than QT, causing the RP to fall, is that the checking account of the government as of June 7th was almost zero. If you recall, we almost had a government shutdown because the government was out of money. And this is their money, the Treasury General account. Very low, now quite a bit higher, about 700 billion. Their target is 750 billion, and we'll come back to that. But as you can see, it's gone up by 650-ish billion dollars. And the RRP has come down. Liability down, liability up. Now remember, as I said with QT, this is the policy. The policy is to reduce the assets on the balance sheet. The change in the RRP is the outcome of that reduction. Similarly, when the TGA, when the Fed, when the Treasury decides to save money and not spend it, and the TGA liability of the Fed goes up, some asset needs to go up or some liability needs to come down, and the liability has been coming down. Okay. Now, the last Fed liability is bank reserves. And so it's a little complicated. I won't go into depth on it, but basically, reserves are the offsetting asset on a bank's balance sheet, a private bank's balance sheet, that private sector bank's balance sheet that offsets deposits. And so, as you can see here, the deposits have, or the reserves have risen. And once again, this actually is a market forces thing. RRP down, reserves up, but reserves are not going up very quickly. So that makes sense. But what is happening is that the money market fund investor prefers to buy treasury bills more than bank depositors do. And so the bank deposits are rising and the RP is falling because bills just happen to be more attractive to money market funds than generic bank depositors. Okay, so now let's see how all this adds up so you can get a sense of what I'm talking about. So here's the Fed's balance sheet as of the most recent weekly. The RRP is a daily number, and people focus a lot on how it's moved a lot, but it gets back in line every week. You just have to do the math. So here's where we stand. And here's where how we've changed since so again, assets, SOMA portfolio, liabilities, RRP, TGA, and reserves. And these are the big ones. These are the big things that matter on the Fed's balance sheet. Since the debt ceiling resolution in early June, the SOMA portfolio, QT, has fallen by $418 billion. Okay. RRP, as I mentioned, has fallen quite a bit, but TGA has risen a lot. And so most of the fall in the RRP is because of the TGA. Also because of SOMA, but a lot because of the TGA. Reserves have gone up a little bit, and these numbers are close enough for government work to be accurate. There's a slight discrepancy in the timing of various numbers. For instance, the TGA and the RP change every day, and yet the timing of things like when a T-bill settles, when a spending is sent out, changes intraday, and the timings are never perfectly aligned. So I thought it was helpful to look at, let's see how it looks when you look at the weekly change. So this chart does that. And you can see, again, changes in liabilities, RRP, TGA, and reserves, versus the change in the Fed SOMA portfolio. They basically track perfectly with some wiggles around it. Trust me on this, the wiggles are not particularly important. It's the direction of both. Bottom line is SOMA and changes in TGA affect RRP and reserves. So let's go back to that sheet. Now, here's the thing. What's the pace been like of each of these things? So firstly, what's the time been like? It's been 24 weeks in this change. What's the weekly pace like? Well, it's like this. This is dividing that chart I just showed you by 24 weeks. And you see the RRP is falling at a 200 billion a month sort of pace. And if you extrapolate that, I'll do that. If you extrapolate that, the RP goes to zero in 18 weeks. 18 weeks, Jesus, that's soon. We're going to have to deal with the RRP going to zero in the first quarter. But let's look at this weekly pace. This weekly pace is not going to change. That's 60 billion of QT of Treasury QT, or roughly 13 billion a week, 31 days, blah, 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 and some mortgage. And that's not really going to change much. The TGA, however, is already fully built. Is it going to increase at 25 billion a week? No, it's going to stabilize at 0 a week. Now, bank reserves, you never know how bank reserves versus RRP are going to work. But what we do know is this. So we'll go down here. Let's make some adjustments to have a projected weekly pace. Again, no reason to change that projection. That's the QT plan, and it's been going on like that since QT ramped up in September of 2022 to its full size. Now, given that we know that assets are going to change by 17, it makes sense to project that liabilities are going to change by 17. Now, again, that's not exactly what happened, but it's close enough. So, okay, fine. So now what about reserves? Should we project reserves to change at the same rate? Well, we can, or we can change that rate. So let's fool with that. Now we have to solve for a $17 billion weekly change in liabilities. So I can do that by just having a formula that does that. And what it says is if you assume reserves change at the current pace, which is a slow pace, RRP falls by 23 billion a week. If that's the case, and given the current level, which again, the daily will be updated on Thursday actually, but that's the current November 22nd number. From November 22nd, at this pace, the weeks to zero is 39 weeks, which is sometime in July and August. So not immediately. It's not happening immediately. Now, there's other alternatives. Reserves could not increase at all, just stay flat. In that case, it takes over a year. Or, and I think this is an aggressive assumption, let's assume that every bit of the SOMA portfolio is financed by the RRP, meaning all the runoff, plus it comes from reserves. So in this case, reserves go up by how much RRP goes down. In other words, let's just put 17.42 in here. In that case, RRP falls at, so again, reserves fund none of the SOMA portfolio. Now, this is a very conservative assumption. It assumes that the RRP funds all of SOMA and the reserve increase. In that case, it takes 26 weeks, and we're 6 months from now, which is May. Anyway, you can fool with this, but these are the extremes to me. This is an extreme number, 26 weeks, and this is an extreme number, 0, and this is an extreme number, 53 weeks. It's going to fall in somewhere in there. I'll write another video at some point, or do another video at some point about the implications of the RRP going to 0, but as a headline, it's going to be an interesting period of time. Private sector repo. The one thing that's clear is money market funds are going to still have a ton of money that they're going to want to invest in overnight repo. And the RRP may not be available for that. It will be available. They can invest in it. They don't have to. And if they do, that means bills have to be bought by someone other than them. So it's unclear whether there will be demand for overnight repo, but another place that the money market fund can invest is in private repo. And if they do that, there won't be a stress on the treasury system. Anyway, that's another topic. I'll come back to that. I hope this was helpful. Once again, it all adds up. The things that move all the same way. It's just math. It's just accounting, even more so. And the principal drivers of the steep slope of the RRP to date, since the debt ceiling, 65, I guess it's 50% of the change in the RRP has simply been the TGA build. Thanks for listening.